Hi, I'm Pattu from freefincal. Let's take a look at Nippon India Nifty 50 Value 20 Index Fund, whose new fund offer starts today from February 4th to February 12th. There are two index funds released by the AMC today. One is the Nifty 50 Value 20 Index Fund, and the other is the Nifty Midcap 150 Index Fund. I have reviewed both funds in two separate articles. We'll look at the value index fund in this article. So this is going to be an open-ended index fund that's going to track the Nifty 50 Value 20 index. This index chooses 20 value stocks from the Nifty 50. This typically means that they will take they will list stocks in terms of low PE, low PB, high dividend yield, and ROCE, and they will give 40% weight to ROCE, 30% weight to PE, 20% weight to PB, and 10% weight to dividend yield, and they will create a rank based on these composite factors, and the top 20 so-called value stocks will be part of this index, and they will do a rebalancing once a year, and the cap for each stock is 15%. So every year when they rebalance, they will ensure that each stock will have a weight of 15%. But that 15% is a rather high cap, because something like the Nifty 100 low volatility 30 index has got a 5% cap at the time of rebalancing. And typically, if you notice, in that kind of a low volatility index, every stock has got almost equal exposure. It's like an equal weight, almost like an equal weight index. Now, the problem with value index is that it's buying stocks that are that are supposedly trading lower than their intrinsic value, not or at least close to their intrinsic value. And the problem is that unless the market discovers these stocks, they may remain low at for a very long time, what people call as a value trap, and so on. So, and this will always be investing in that kind of value stocks. See, the traditional notion of value investing is that you identify stocks which are trading below their intrinsic value, and you keep holding. When the market discovers the value, the stock will zoom up and you get a multi-bagger. But once you get a multi-bagger, how many people will have the temperament to sell it just because they got a multi-bagger, right? That's going to take a few years, and they're just going to keep holding it. Whereas this will replace those stocks. Once the stocks have moved up, then those stocks will be removed from the index, and they will be replaced by another value stock, so-called value stock. So, is that really does that really make sense as a strategy? I mean, in an active fund, some very good active funds like Value Discovery, Quantum Long Term Equity, they have done well over the long term. They have really done well, of course, through periods of frustration. You can ask investors, they will tell you there are periods of frustration, and that's going to be seen in this as well. And the problem is, we don't have too much data. We have only data from January 2009. If you plot the Sims Evolution Index, the red is the value index and the Nifty 50 is the black line. This looks very impressive, but you have to actually look at the rolling returns to understand. So if you look at the 5-year rolling return, the blue is the Nifty Next 50, the brown is the Nifty 50, and the yellow is the value index. I'll probably show you that in a bigger graph. So you can see the yellow is the value index, the brown is the Nifty 50. You can see for a very long period, the brown line and the yellow line are more or less on top of each other. So which means that that's the problem with the value index. There can be a long period of underperformance, and also remember that for this value 20 index, they may charge a higher expense ratio. So if you add expense ratios, then the value 20 index fund may underperform the Nifty 50 index fund. So and for the very limited amount of data that we have, over 7 years, the yellow line is a little bit above the brown line. Yellow line is the value and the brown is the Nifty. And over 10 years, a very, very short, small amount of data, just 516 data points. So that's investments done over a period of 2-3 years. And so that only that has outperformed the Nifty, but there's not much data. If you actually look at the US, but before we look at the US, this is the drawdown. That is the maximum fall from the peak. That is, if the index hits an all-time high, how much it falls from there. You can see there's not much of a difference between the value index and the Nifty TRI. And in terms of standard deviation also, there's not much of a difference. The volatility is also not much of a difference between the two. But if you look at the US, you get a very different picture. And this is the red line is the S&P 500 total returns. The black line is the S&P 500 pure value, which is more or less similar to our value 20 index. And you can see that the value index is not only more volatile, and it has also underperformed for the last 10 years. So this situation may come in India also. As the markets develop, and then you may have this kind of underperformance over 10 years, and this may be because value investing is essentially more risky than index investing. Not many people point this out. So I don't see any great benefit in investing in this, because it's going to be a frustrating experience for new investors. They think that they are actually doing some value investing, but they are only doing value investing. It's not that value is not going to become multi-baggers. If it's going to zoom up in value, then it will be removed from the index, and sometimes it may be even be removed prematurely. So I don't think it makes any sense to buy this fund. Please avoid. Bye bye.